Did you know that there is a single document that reveals the health of a debt fund before you invest? But most investors don't even know that it exists. Today, we're going to be diving into the loan tape and why it's a critical tool for protecting your capital. Welcome to the Grow Your Cashflow podcast. I'm your host, Pascal Wagner, and in this solo episode, I'm going to break down everything you need to know about loan tapes, one of the most powerful resources for making smarter, more transparent investment decisions. We'll cover why this document's essential, how it reveals the true performance of a fund, and then the red flags to watch for before committing your hard-earned money. If transparency and protecting your investments matter to you, this episode is a must listen. So let's dive in. So the first thing I want to discuss is a loan tape. What is a loan tape? A loan tape is a document that provides a detailed list of every loan in a debt fund's portfolio. It includes key metrics like loan amounts, interest rates, borrower information, and performance history. And so why do these things matter? First, one of the things that I am always looking for when I am investing in an LP passive investment is I want to know everything about the operator and the deal. And to me, the loan tape is one of the first steps in transparency and really being able to assess how forward and transparent a given operator is about their fund. And when you look at a loan tape, it very clearly outlines how many loans are in a given portfolio, what is the health of those, like are there any of those loans that have stopped paying, what are the interest rates on each loan, who are those loans to, how big are the loans, when do those loans come due and are they expected to be paid? These are all the different types of things that you can look at and really understand the health of an investment or debt fund. So as investors, we are not just looking for returns, but we're looking for that transparency. And I think the first point I want to make is if a GP won't share or an operator or someone who you're investing with won't share this information, it's time to walk away. So I would love to give an example of what does a loan tape actually look like. And with that, I'm going to pull up a loan tape for a fund that I have personally invested into, and we actually have an investment opportunity where you can invest with $50,000 instead of the $200 required into the DLP lending fund. But I want to give you a good example here of what this looks like. So here on the screen, it's very small. I'm gonna dig in here in a minute, but as you can see, this is like a 2-page document that shows all of the different loans that this fund has. So if we dive in and get a lot closer, let's just start at the top. So as you can tell, this is detailing every single item within the portfolio. So, this loan is in multiple different cities and states, whereas this one is in Cape Coral, Florida. A zip code, what is the loan amount? How much this particular fund, the DLP lending fund, provides loans to real estate operators to basically purchase and renovate their properties before putting them back into permanent financing. And so here you can kind of see, okay, what is the purchase price of the properties that the operator is buying and how much are they eligible for? What is the loan to value? What is the, if the property is $1 million and they're given an $800,000 loan, that's an that's a 80% loan to value ratio. And so you can understand how much leverage are these real estate operators taking on, or how risky is the fund in giving loans? Is the fund giving loans that have really high loan to values? In theory, a lot more risk, or are those loan to values a little bit lower? In the 50 to 100% range, 50 to 60% range. So here you can see, they're all over the map. So Some are in 70, some are in 97, some are 19, 10%. These are all the different things you can kind of look at as a whole and understand how does this fund make loans and what is the makeup of that fund. You can see kind of when is the loan closing date, when does that loan mature, what is the interest rate of that portfolio, what type of property is this loan being lended on, how long is the month term. Love it. Pull it back up. LP loan tape. And ultimately, the point I want to make is that it is a very transparent look on what does the fund look like that you're investing into, which if you are an investor, I always say, the operator should be as transparent as possible if you're going to give them tens or hundreds of thousands of dollars of money. There needs to be that level of trust. And so why do I bring this up as a topic to even bring and have as an episode? The reason is because I have a story or a cautionary tale where I've invested in multiple different debt funds. Here I have the DLP lending fund, which I just showed you, that provides loans to real estate operators that are in the workforce housing niche, primarily in the southeastern part of the United States. But I've also invested in the Polaris Cannabis Fund. And I want to highlight a little bit about what that fund is, why I invested into it, what was my due diligence process, and what did I learn and what mistake did I make. So first, the Polaris Cannabis Fund is a fund that I'm currently invested in that provides basically lending or long-term mortgage notes to operators that have cannabis grow house facilities. So in the United States, it's currently still illegal to get cannabis. For cannabis, it's not federally legal everywhere, right? And so operators or grow facilities, imagine these massive warehouses that, where they grow plants for cannabis. These are not eligible for your standard federal, 10, 20, 30-year amortized loan products. And so if you are running a massive warehouse or grow facility, you need to go and try and find private financing in order to be able to take out some leverage. If we're talking about a $20 million warehouse, it's really difficult for a cannabis operator to go fork over all 20 million. And what they're trying to do is, hey, I'm going to go buy a building for 5 million and get a loan for the other 15. And now we need to go out to the private market to do that. And the Polaris Cannabis Fund is one of those operators or fund managers that provides those loans. So there's a very clear demand and value proposition for this fund to exist. And because it is illegal federally and these grow house facilities can't get access to these federal loans and they need to go private, loans are actually significantly higher in terms of interest rate than what you would usually be able to go get federally. And that's what made this fund particularly interesting to me, is that, historically, this fund had generated between 12 and 16% on an annual basis and made monthly distributions. And so for me, that was one of the best kind of debt funds or unique opportunities. It's been distributing those types of returns for pretty much the last 5 years. And so as an investor that's looking into these types of deals, one of the things that I preach is, look at people with a track record. And this was a firm that had that kind of track record. They're not just, their first year in business offering these returns. They'd been doing it consistently for at least 5 years. And as part of my due diligence process, I went through the loan tape, as I just showed you, of the 40-ish loans in their portfolio given to these warehouse grow facilities. And, I think one of the big lessons that I've learned in this scenario is that when I initially invested, this was in, I believe, August or October. Yeah, no, it was in August of 2023. And everything on the loan tape was fine. And then after I had made my investment, within several weeks, the newest loan tape came out and showed that there were loans that started to be delinquent, meaning there were, of the 40 loans, some of those warehouse grow facilities started having issues and could not make all of their interest payments or halted interest payments altogether. And as someone who just recently invested in the fund, I was looking at it, but I didn't take action quickly enough. I also didn't really quite understand how quickly these tides could turn. And so within a few months, so I invested in August, by the end of the year, the fund basically dropped, had so many loans that were not performing that they halted people from making withdrawals from the fund to prevent a run on the fund, just like there'd be a run on the bank and the bank doesn't have the money and the fund might have to sell all these assets in a distress situation, get significantly less, and basically make the fund implode. The fund, all of a sudden went from making 12 to 13% annualized distributions down to 5 or 6%. And of course, as an investor, if you're going into a fund like that and you're expecting these double-digit returns and all of a sudden you are getting half of that, you're starting to ask, why am I in this fund? Which is the same question that I had. And so, it makes sense. Pelorus then put a block on investors pulling their money out, and they basically said for all of 2024, you are not doing any withdrawals, and you kind of just need to stay in the fund until we can take over these warehouse facilities or work out another loan arrangement with these operators to get them to continue paying again, and to basically right the ship. Now, I like to look at this in a couple different ways. First off, I understand this is a risk that happens when you invest in these funds. I think first and foremost, when you come in as an investor, regardless if you're investing in the stock market or if you're investing in these passive LP investments, there is risk, and it's a business, and the business doesn't always go up and to the right. So I think lesson one is just, being aware and making sure that that's a reality of these expectations of investing in these types of funds. But two, you have to look at it on the side of the fund operator. In order to protect my capital or investor capital, they want to avoid a run on their fund. And so by locking up our funds and having the time to right the ship, get some of those loans performing again or taking over the assets and recapitalizing, maybe selling them after they take them over, and I'm still earning 5 to 6%, which if you think about it in terms of, I'm basically earning the same thing as treasuries today. But also definitely, if you're someone who is relying on that income, now all of a sudden it's cut in half. I think pros and cons, obviously I would love to pull my money out. I've already put in a withdrawal request, and whenever they do open up, I'm going to be, trying to shift those funds somewhere else. But I think the point here is that had I paid attention to the loan tapes a little bit better, I would know, hey, this fund is trending in the wrong direction, or, even better might be, before I wired the funds, let me take a good look at the loan tape one more time and make sure that I'm reviewing that on a monthly or quarterly basis to just make sure that my funds are safe, protected, and deployed with the right operators. So, I think these are just like key things that you need to pay attention to and look for when you are investing in these debt funds. And first, and I just told this tale, but something that I've realized as I've been talking to many of my students in the Cashflow Academy, that they're not even aware that they can ask for or demand this type of paperwork to be presented to them. In the ideal scenario, you are investing with operators that are institutional, that have hundreds of millions of capital under management, which in this case is true, and that they have audited financials, which in this case is true, and that they provide a loan tape of like, show me exactly what's in there. And I think as a passive investor, regardless of what you are investing in, you should know down to the detail. You should have those documents at your fingertips. And if an operator does not provide that, that should be flag an alarm and should cause you to think twice. And in my case, I always say there are enough great funds out there that if an operator is not willing to provide you these basics, that you should run. So I would like to wrap up this episode with just by, highlighting the importance of when you are investing, particularly in debt funds, that these are the types of documents that you should be, number one, requesting for and be given. And two, it's something that you should be paying attention to when you have your money invested in the fund, to know how is the fund performing? What is the health of that fund? Is my capital safe? Now, do I think the team at Polaris is awful, or, do I think it was mismanaged? I don't. I think I've spent quite a bit of time with the guys at Polaris, and I think that these are just the realities of the market dynamics happening within the cannabis industry that caused this to happen. And that can happen in almost any industry. But when you are investing, these are the things to pay attention to, and no one will protect your capital as much as you will. So with that in mind, thank you for tuning into today's episode. I hope you gained a tremendous value and actionable insights to help you on your passive investing journey. And if you're ready to dive deeper and access resources to grow your passive investments, I've put together a free starter kit just for you. So when you download it, you'll gain access to my newsletter. Sometimes it's daily, sometimes it's weekly. And every single Friday, I'll send you 5 vetted or curated deals that are oriented around cash flow, along with give you tips and resources and access to paid workshops to help you become a smarter and more confident investor. If that's interesting to you, you can grab your free starter kit now at passiveinvestingstarterkit.com. And it's the perfect way to get started or take your passive investing to the next level. Thank you for listening, and I will catch you on the next episode.